So this is an article that I saw today on news.com. Everyone's favourite news outlet, really hard-hitting journalism on news.com. But I thought it really did sum up the national psyche. Not so much the current media cycle, but the actual national psyche. And you see a few concepts in this article which are just repeated over and over again, decade after decade, year after year. And these same points are used for both sides of the argument. It's a good time to buy, it's not a good time to buy. Okay, as a previous owner and manager of Australian Property Investor magazine, I definitely understand the Australian property investor news cycle. Okay, it comes in bull and bear, bull and bear, bull and bear. And I guess now it's a little bit confused, okay, because I did see two articles on the front page of the AFR website. I don't, have the tangible paper version of AFR. I tried to pay for it last week when my credit card updated my details on there, and they said we can no longer deliver to your location, which is only about a kilometre from the CBD of Hobart. So I am stuck with looking at AFR online. But on the current homepage, I wish I had a screenshot of AFR. It was two property articles taking centre stage. So property is once again back on everyone's lips. Now this headline here, fury over bonkers stat about Australian investment property ownership. What does it mean? What are they talking about? Well, they've got some new data from the ATO. They've talked to a couple of, industry insiders, managing director of the Australian Housing and Urban Research Institute, supposedly impartial, and a lecturer here from the University of Sydney. Now, two important points that I wanted to talk about. And now this is coming from a property investor perspective. I'm trying to show another perspective here. Okay, this commentary, it's coming amid a worsening housing crisis nationally, with vacancy rates at historic lows and rental affordability at its worst levels in nearly a decade. What does that mean? There's not enough investment properties for people to rent. Okay, the rental demand is not being serviced. Now, if these people could afford to or had deposits to go out and buy a property, they would be. If they wanted to buy a property, if it was their preference or they had the ability to buy a property, then they would be. Okay, that's probably more just a common observation. But they are not. They are wanting to rent properties. It's not up to property investors to, dictate to people what they should be doing or what they shouldn't be doing. If their preference is to be renting properties, then that is supply and demand. Property investors are providing them a product, and generally a good quality product, as the legislation forces us to provide based on, maintenance requirements and limiting rental increases and all of the other wonderful things that tenants have stacked in their favour. Okay, so we're providing them a good quality product. And, typically people like good quality products. You like to go out for a good meal, you like a good quality car, all of these things. So we as landlords are providing a good quality product as protected by legislation. And prospective tenants are wanting more of it because vacancy rates are at historic lows and new housing supply is very low as well. If they wanted to buy, right, and I know, we don't live in a perfect world. A lot of people that want to buy can't, or they don't have the deposits. If they wanted to buy or they were not able to, they would be, but they don't and they aren't. They are wanting to rent at the moment, and investors are providing them that product that they require and they need, and that it is a good quality product. And they are not, we just can't service that level of demand. Okay, so we have to understand that property investors are providing something which is, a social good. It is providing a social outcome which is in strong demand. We're not the bad guys. Okay, and then now the next sentence here following on from that, which is actually very contradictory when you break this down. Okay, so property investors, they're not the problem. They are the solution to this need. But then they come in and say, well, most young Aussies believe home ownership is unattainable as they remain locked out of the market. Now, which market are they locked out of? All right, because I know when I moved to Sydney to the big smoke from Hobart, Tasmania, I rented. Okay, and I rented a one-bedroom unit, and I was doing everything that I could do to save money to get ahead. Okay, I grew up with my dad. He was on the sole parent pension. All right, and I was focused on being able to buy my own home. Now, I wasn't under some sort of, I guess, belief that I could walk out and buy myself a house in Mossman or, within 20 kilometres of the CBD of Sydney. Buy a house full stop, okay? I rented a one-bedroom unit. It was on the train line in Sydney, okay? That's how I focused on getting ahead. I purchased 5 investment properties before I purchased my first home. And you might say, well, you're part of the problem in all of this. I was buying these properties in locations which needed housing. They were transient locations where people desperately wanted to rent first before they purchased. And I was providing them an outcome to be able to move to this market, dip their toe into the water, rent first, the job goes well, all the wonderful things are happening, they like the area, then they come and buy. We are providing a social good. And in doing so, I was able to access the property market, take the profits from those properties over a few years, take those profits and buy a house to live in Lane Cove, okay, an aspirational place to purchase nationwide. That is how I did it. I came and did that from very low means at the time. As I said, I grew up with dad on the sole parent pension. Now, you might say, well, I bought that first property 20 years ago, as of this year. Well, you can't do that anymore. Things have changed. I'm here to say they have absolutely not changed because very recently, this was a property that we purchased for a client. Now, this is on an advertisement. This is just to give an illustration here of what is possible. This is in a very strong capital growth location. You're buying this property for capital growth. Since 2015, our average annual compounding capital growth performance has been 17% capital growth. So this is buying a very strong, high demand property that is generating you a deposit whilst you sleep. This is like buying a business with a very healthy balance sheet, and then you keep saving, you buy this property, and it's saving with you whilst you sleep. And now you've got a second employee on the books. You buy it, use this one and your savings to potentially buy another property, and now you've got a second business on the books. And these resources are all contributing to be able to get you ahead to purchase a principal place of residence, if that's what your desire, or go part-time in your work. This property, $270,000, so very similar to the $145,000 property that I purchased 20 years ago as my first investment. $380 a week rent, 7.3% yield. After tax, this is actually paying you about $10 every single week of the year to hold the property. For the privilege of holding this property, you're actually getting paid for it. And we project this property is going to generate about $42,000 in capital growth in the first year. So you can see that this is saving you about $800 every single week in equity. It's like a savings account, and every day you go down to the end of the driveway and get over $100 out of that ATM machine and put it into your back pocket. This is what that property is doing. It's not costing you anything to hold it cash flow wise, and every single day you're essentially going and getting $100 out of the bank for this property, earning money while you sleep. Okay, that $100 a day, a little bit more than $100 a day in equity production, goes in addition to the money that you are still saving. And that is how you get ahead in this property game. You act strategically. You work within the guidelines provided to you by the government, which is, I'll get to that in a moment, some tax optimisations which arguably are not relevant. The return on investment here is over 100% in the first year. Now, how much does this investment cost? $42,000 is a deposit and buying cost that you would require to purchase this property. So that's very accessible for people to save up right now as of today in 2023. And you can see here the holding costs associated with this investment. You know, you've gone through full comparable analysis. We've gone through, this is in the highest capital growth locations in the country, full checklist, etc. Property investment is very accessible. This is the type of stepping stone property that gets you from 0 properties into your principal place of residence for new, younger Australians. Now, the next point I wanted to make down here is the government, so this bloke here, up here, the Managing Director of the Housing and Urban Research Institute and also the Senior Lecturer at Sydney Uni, they both came to the realisation that governments need to re-examine how they are prioritising second and third properties. Dr. Troy advocated for the removal of tax concessions, negative gearing capital gains to people buying a property for investment purchases. I'll give this guy a hot tip. Not many people in this environment that purchase a negatively geared property are buying 2 or 3 properties, okay? Even on an average Australian income, one heavily negatively geared property is enough for the banks to say, no, you can't service any more debt. Okay, so this policy change is not really impacting good or performant Australian property investors. Now, this property here, it's not impacted by negative gearing because it's positive cash flow, okay? Even in the current interest rate environment, it's generating an income in your pocket every year. So changes to negative gearing are not going to impact this type of affordable, extremely high demand investment grade asset. Okay, so if they were to change those concessions, that doesn't impact us as high performance property investors. And capital gains discounts, well, capital gains is something that you don't, tax discounts is something that you shouldn't be focusing on paying. You should be looking to hold an asset. Ask yourself the question, why would you ever sell an asset? I would sell a liability. I wouldn't sell an asset unless I really had to, okay? You're wanting to hold these assets. You can refinance, you can repackage them. You can even sell them into different structures if you need to optimize your outcomes and create that net worth position in the long term. So look, we need to look, I guess, a little bit deeper into these articles because really, there's no new information here. This is just repeating a lot of the concepts that have been out there for decades, for the whole time I've been into property investment now for 20 years. The same talking heads talking the same policy changes, negative gearing, capital gains tax revisions. This is just a washing machine that keeps cycling around. And when you dig deeper into it, it is complete fluff. Us as property investors need to focus on quality assets and not get wrapped up in the whole, well, young people can't access the property market, because I'm here to say that they definitely can. All right, so if you see any of these articles you'd like me to take a deeper dive into, please let me know. We'll unpack it from a property bull's perspective, a realist perspective, not necessarily a blind bull, but someone who's taking a deeper dive with logic and common sense. All right, guys, if you like this conversation, you like this type of content, then it might be worth having a chat with us here at Ripehouse. There's a link below to book in a 15-minute no obligation discovery call just to talk about what you're trying to achieve in property investment and to talk about if we would be a good fit to invest and to assist you alongside. Thank you.